if there's a big scare in the markets, if the AI bubble goes from deflating to exploding and we have a 2008 scale event, something like that, everything's going to get whacked, including gold and silver, and the stocks will get whacked. And like these data centers, these things take millions of ounces of silver to build out this infrastructure that we're looking at. We're not talking, a speck in your cell phone. We're talking kilos and kilos, kilotons overall, particularly in the silver space. You'd think, it fell, it crashed from 120 down to 70, whatever shall we do? But the mines were built with the idea of sub $20 silver. So 70 is a phenomenal price for the actual business of mining this stuff. The fact that their margins have expanded so much they can afford a lower price. If gold drops $1,000 in one day, the gold miners will still make a ton of money. When people say, well, would you be willing to buy gold at $5,000? And I say, well, bullion, sure. Friend Rick Rule likes to say, I buy it because I'm afraid it's going to 10,000 or whatever.
So obviously silver had a way sharper haircut than gold during the recent, kind of blow off top. And so I'm kind of curious if the outlook for silver has changed. I mean, obviously we're still in a deficit and such, and I don't know what silver measured in dollars should be, considering this deficit or how high to go. But there's just so much other variables that plays into silver, and so just curious in your outlook on this particular metal.
Well, I have for some time been called Darth Silver because I keep pointing out that it has an increasingly important industrial side. And the funny thing is that in the current context, I think that's actually a plus, not a negative. Like, instead of hating on me for pointing out silver's industrial side, we've got all of the factors that are bullish for gold are bullish for silver. And at the same time, like these data centers, I don't have the math on this, but I've heard, and not just from silver bulls, but I've heard on mainstream analysis, like these things take millions of ounces of silver to build out this infrastructure that we're looking at. And to power it, we want more nuclear energy. And you can say, oh, well, renewables and coal and other things. Sure. But we're going to need it all, including nuclear. And the control rods for a conventional nuclear reactor use a lot of silver in them, a lot.
Silver's sharper drop isn't weakness, it's its leverage revealing itself. As Lobo Tiggre points out here, the industrial side isn't a liability anymore. It's demand that doesn't care about short-term rate chatter. Data centers alone are projected to double global electricity demand growth by 2030, and silver is embedded in that infrastructure from circuitry to nuclear control systems. When deficits meet structural demand, volatility becomes noise, not thesis-breaking evidence. What Lobo Tiggre hints at next reframes silver not as a trade, but as a supply chain choke point investors may be underestimating.
We're not talking, a speck in your cell phone. We're talking kilos and kilos here, or kilotons overall. So there is not just someday, somewhen, theoretically, yes, silver is an industrial metal. There is right now a market trend and a deployment of capital that demands a lot of silver. And it's going to demand it whether the Fed increases rates or drops them by 25 basis points and all the kind of shenanigans that move commodities prices around for silly reasons. None of that matters to what's actually happening. Not someday. It's our friend Rick Rule saying, don't confuse the inevitable with the imminent. It's not just inevitable or imminent. It's happening now. Mm-hmm. So I'm actually quite bullish on silver, and I'm bullish on silver this year, but that doesn't mean that it can't or won't correct more before it goes up. Like we've just seen this historic spike and retreat. And I just think it would be irresponsible for anybody to say, oh, I know for sure this is what's going to happen next. It's going to go straight to the moon from here or straight to hell from here. I wouldn't believe either one of those statements.
Rate cuts grab headlines, but capital deployment drives reality. As Lobo Tiggre makes clear, industrial demand isn't theoretical. It's tied to infrastructure budgets already approved and funded, independent of whether the Fed tweaks rates by 25 basis points. Global silver demand hit record levels above 1.2 billion ounces recently, and structural buyers don't pause because CNBC flashes red. That's why volatility after a spike doesn't invalidate the thesis. It simply resets positioning. What Lobo Tiggre implies next is critical. Bullish doesn't mean blind to corrections.
I think it behooves us, even the most ardent silver bulls, to give it some time. Let's let it settle out a bit. Let's see how the trend shapes up. But from a fundamental perspective, I'm very bullish on silver. And if we do get more correction, at some point, if the stocks, like we were just talking about how the stocks haven't corrected that much, if that changes and silver scares investors enough that the obvious winners amongst the companies go on sale, I think that would be a gift. I would want to buy that with both fists, or paws, as the case may be for a wolf.
Yeah, for sure. Yeah, I was looking at the silver price per ounce in the last cycle. I think in 2008 it fell from like $28 to about $9 or something like that. And I was just thinking, like, yeah, that was like a big haircut. That was over 50%. Haircut and such, and then it ended up rebounding, going up to $48. But can folks stomach that type of volatility? That's going to be the test.
Yeah, and you know what? I'm glad you brought that. There's a couple of things to say here.
The real test isn't silver's fundamentals; it's your emotional tolerance. As Lobo Tiggre reminds us, in 2008, silver collapsed nearly 68% before tripling into 2011. And that kind of volatility wipes out weak hands long before the upside arrives. Corrections create generational entry points, but only for investors with liquidity and discipline. If stocks haven't fully corrected yet, history suggests forced selling during broader equity stress could change that fast. What Lobo Tiggre is building toward is a strategy that separates conviction from blind faith.
One is, people get mad at me. They treat me like I'm a trader because I took some profits on the way up. But if you take some profits on the way up, I got to tell you, it helps with that intestinal fortitude and the volatility. Like, I just need to quote other people besides Rick, but he's so quotable in this context. Like, he talks about having sailed beyond the point of no concern, right? Taking enough profits to still be long, still have upside, but not be able to lose money because you've already taken more money back off the table than you put in. So having done that as well, I mean, what do you do with that money? Well, one, I paid off my mortgage. That doesn't make me a trader to silver and gold. I think that, personally, that makes me a person in the mood to celebrate. But I still have plenty of cash to deploy. So if we get that, 2008 kind of scare, then I will have the cash to act when I see those obvious screaming buys. And by the way, I remember this very clearly in 2008. Less so 2011 and 12, and that was more of a grind.
Taking profits isn't betrayal, as is risk management most investors ignore. As Lobo Tiggre outlines, de-risking on the way up creates psychological and financial flexibility, especially when markets can drop 30% to 50% in liquidity shocks like 2008. The S&P 500 fell 57% peak to trough then, and margin calls forced indiscriminate selling across assets, including gold miners. Having cash isn't bearish. It's optionality when others are trapped. And what Lobo Tiggre signals next is how disciplined liquidity becomes power during panic.
But in 2008, when the markets just went boom, like the elevator just dropped, like the cable was snapped, and people sold gold and silver, not because gold was doing anything wrong, but just because they were hit with liquidity, they had margin calls, and they had to sell whatever they could to satisfy their margin clerks and whatnot. So I remember getting anguished emails from readers back in my Casey days. And the anguish wasn't, oh, you bastard, you told me to buy these stocks and now they're going down. No, that wasn't it. They understood. Our readers, at least, they understood that if not generational, then at least once in a decade buying opportunity was shaping up. And their agony was, I'm all in. Like, I get it. Oh, man, look at these bargains. I want to back up the truck, like Doug Casey says. There's a Doug Casey quote. Back up the truck, right? I want to back up the truck. but it's fully loaded. I have no cash. I'm all in. I can't buy these things. So that's sort of my defense of the idea is buy low, sell high.
Liquidity crises don't ask what's fundamentally sound. They force liquidation anyway. As Lobo Tiggre highlights, 2008 wasn't about metals failing. It was about margin calls cascading after the S&P 500 ultimately fell 57% peak to trough. Investors didn't sell gold miners because they lost faith. They sold because brokers demanded cash. That's the silent risk in any bull cycle. Overexposure removes your ability to act when true value appears. What Lobo Tiggre is really warning here is that opportunity only exists for those who preserve liquidity beforehand.
You can't forget the sell high part. And if you do sell high and it goes even higher, don't have FOMO, don't have sour grapes. You can't lose is a great thing. And you have cash in case there is a fluctuation and you need it. So I just think you stick to discipline, you don't give in to FOMO, and you come out ahead over time. And, when people say, well, would you be willing to buy gold at $5,000? And I say, well, bullion, sure. I don't really care what the current gold dollar exchange rate is. Bullion is savings. It's not a speculation. I don't buy it because I think it's going higher. As our friend Rick Rule likes to say, I buy it because I'm afraid it's going to 10,000 or whatever. And the time to buy insurance is not after the catastrophe strikes, it's before. And if you see catastrophe coming, you're not too worried about the cost of the insurance. You just want to make sure you've got it before the disaster hits. So that's the way I think about bullion, and that includes silver, of course. If I have savings that I want to put away for the long term, then I accumulate.
There's a quiet difference between insurance and speculation that most investors blur. As Lobo Tiggre explains, bullion isn't about chasing upside. It's about preserving purchasing power in a system where US debt has crossed $34 trillion and currency dilution is structural. Selling high and holding cash isn't weakness. It's strategic flexibility, especially ahead of Fed policy pivots or liquidity shocks. FOMO destroys discipline faster than volatility ever will. And what Lobo Tiggre implies next challenges how investors separate core savings from leverage trades.
And of course, I don't try to do that on an up day. I try to buy the dips and so on. But yeah, I'm happy to do that. Basically, that's a constant for me, not a variable. The stocks, on the other hand, they add leverage. So if we're in a period of correction and consolidation, it is reasonable to expect there to be buying opportunities. And so, no, I'm not doing that today. In fact, not entirely, but I'm pretty much on hold in terms of buying gold and silver stocks, because despite the big corrections we've seen, the better companies, they're doing fine. Many of them are at all-time highs or pretty darn near all-time highs. It's striking to see this, particularly in the silver space. You'd think, oh, it fell, it crashed from 120 down to 70. Whatever shall we do? Well, but the mines were built with the idea of sub $20 silver. So 70 is a phenomenal price for the actual business of mining this stuff. And I think that investors, at least people who've been around the block, they know this. And so the silver stocks, the better silver stocks, many of them, just yesterday, last I looked, if they weren't at their all-time highs.
A falling commodity doesn't always mean weak equities. Margins matter more than headlines. As Lobo Tiggre notes, mines engineered around sub $20 silver now operate in a price environment multiple times higher, creating massive operating leverage even after pullbacks. When input assumptions stay low and realized prices remain elevated, earnings resilience supports stock strength, which explains why some names hover near highs, but buying at peaks compresses your margin of safety. What Lobo Tiggre signals next is that patience, not enthusiasm, protects capital in late-stage moves.
A little wiggle at the top of the right of the chart, it was de minimis. So I'm not complaining. I'm not saying that's bad. I'm long. I'm happy to see my portfolio benefiting from this. But as a buyer, my idea is not my original idea, but the idea is buy low, sell high, not buy high and hope to sell higher. And again, Bullion, completely different thing. I think high, low doesn't matter. I'm always accumulating whenever I can. For the stocks, I want to buy low. And if I can't buy gold and silver low, then, maybe there's an opportunity in uranium, or maybe there's an opportunity in copper or oil or something else that I can buy.
Sector rotation is opportunity, but only if you refuse to chase momentum blindly. As Lobo Tiggre suggests, buying strength without valuation discipline turns investing into speculation, especially when commodity cycles historically swing 30 to 50% in short order. Diversifying into uranium, copper, or energy isn't trend chasing. It's capital allocation based on relative value and cycle positioning. Markets reward patience more consistently than excitement. And what Lobo Tiggre implies next is that true portfolio resilience comes from flexibility, not loyalty to one narrative.
How do you process as an investor, speculator? So obviously the mining companies, many folks are saying like, okay, these things are still cheap. We haven't seen the rush into the gold rush into the mining sector yet, even though the stocks have performed relatively well, some of them better than others. And I'm kind of wondering about the all-in sustaining costs. So obviously, they get it at it costs them a certain amount to get it out of the ground. They're selling it at higher gold and silver prices. And so, how do you factor that in, like into your kind of mental model in terms of, because all-in sustaining costs, like sometimes it could seem like just a general number. I use it all the time. I'm like, okay, yeah, all-in sustaining costs on average $1,600, $1,700 gold, right? But it's a lot more complex than that, especially when you get to like going company by company, line by line and such. And so I'm curious, how do you factor in all-in sustaining costs and for companies, especially as the prices stay elevated at these levels?
Right.
The $1,600 to $1,700 all-in sustaining cost sounds precise, but it hides the operational reality underneath. As Lobo Tiggre implies, AISC is a snapshot, not a full cash flow model. And margins at 2,300 plus gold can look explosive on paper while sustaining capex, jurisdictional risk, and grade variability quietly eat into returns. Company by company analysis matters because a miner with a Huandang $150 at AISC in Nevada is fundamentally different from one posting the same number in West Africa. When prices stay elevated, the market starts discounting future cost creep, not just current spreads. Next, Lobo Tiggre forces investors to confront what happens when that margin cushion suddenly vanishes.
So, first, obviously, we've seen major margin expansion. And sure, costs go up too, inputs go up, but particularly with energy costs being down, which is such a huge part of it. It takes a uniquely incompetent management team, or perhaps even a criminal management team, not to make money, especially in the gold and silver space right now. If you're a miner and you're losing money now, there's something deeply wrong with your company. And dear shareholders out there, investors, if you've got some favorite company and it just can't deliver to the bottom line now in this market, you really need to ask yourself if that stock should be in your portfolio. So that's a given. It whenever the metals move like this, it takes a while for the cost to catch up, and there's an opportunity there for that value proposition to really, boom and help you out.
And these are the producers, right?
Go ahead.
We're talking about the producers, right?
Yes. Though if you're a developer, you've got an NPV and a projected IRR, and it's at a certain price assumption. So if you're building a mine now on a, say, $2,500 gold price assumption, and gold is more than twice that much right now, or about twice that much right now, obviously your mining costs or your capex would have to double before that. I mean, it's actually more complicated than that, but you understand what I'm saying.
Yeah.
If your projected margin has doubled, then you can afford some cost overruns.
When margins expand this fast, weak management gets exposed almost immediately. Lobo Tiggre is blunt here. If a producer can't generate free cash flow with energy costs down and gold multiples above old feasibility assumptions like $2,500, something structural is broken. Historically, during 2020 to 2021, Miners saw margin spikes but squandered them on dilution and capex overruns, so investors should demand discipline this cycle. Developers boasting inflated NPVs must still prove capital efficiency, because IRR projections collapse quickly if costs inflate 20 to 30%. And as Lobo Tiggre hints, the real test comes when prices stop being this forgiving.
A lot of cost overruns, in fact. And down, even on the juniors, if this grade looked iffy for your project that you're drilling, but at these prices, it doesn't look iffy, it looks fantastic, well, you might get more credit for drilling off more of that stuff. Whereas in a market where margins are being compressed, adding more ounces that may or may not make any money doesn't really do you any good. So yeah, I think it helps all the way down the food chain. But this is a warning I've been giving, and people don't like it when the voice of reason joins the party and snatches the punch away. But I agree with all of this analysis, and I agree with the thesis that companies valued in real money, gold and silver, the gold and silver stocks are actually pretty cheap, valued in real money. And it's legitimate to value them in real money because that's what they're producing. So it's the underlying commodity and it's real money. So I get that. But if there's a big scare in the markets, if the AI bubble goes from deflating to exploding, and we have a 2008 scale event, something like that, everything's going to get whacked, including gold and silver, and the stocks will get whacked.
Higher metal prices can turn marginal drill results into temporary treasure. Lobo Tiggre acknowledges that juniors suddenly look brilliant when grades once considered uneconomic now pencil out. But that's a function of price, not geology. In past cycles like 2008, gold equities fell over 30% in liquidity panics despite strong long-term fundamentals, proving valuation in real money doesn't shield you from forced selling. The AI-driven equity bubble adds systemic risk. If passive funds unwind, miners get dragged down regardless of margins. Next, Lobo Tiggre confronts the uncomfortable truth about what happens in a waterfall event.
The fact that their margins have expanded so much they can afford a lower price. If gold drops $1,000 in one day, the gold miners will still make a ton of money. But on that day, people will be selling gold stocks left and right. That's my bottom line here. I get the valuation. I understand the question. Yes, I use that all the time in my own analysis of the merits of a company. But I don't kid myself that just because I think this company is strong and can weather the storm, that the baby won't get thrown out with the bathwater in a waterfall event.
Yeah, for sure. Yeah, I definitely could see that, especially with the irrational behavior and emotional behavior. And it all goes back to like investor psychology and so many other factors, right?
Sorry, just real quick. That's how we make money. If Mr. Market was completely cold, calculated, logical, Mr. Spock, not Dr. Spock, Mr. Spock, right? There'd be a lot less opportunity for us. But it's precisely because he gets so irrationally manic depressive and oversells things like way objectively below their value that we can buy low. And then he gets all excited and jumps on the bandwagon and he gets way irrationally exuberant to the upside. And those swings, those mood swings from Mr. Market, that's how we make money.
Strong margins don't immunize stocks from panic-driven liquidation. Lobo Tiggre makes a critical distinction. Profitability and price action are not the same thing, especially during liquidity shocks like March 2020, when gold miners dropped over 25% in days despite solid fundamentals. Even if a miner remains cash flow positive after a hypothetical $1,000 gold drop, ETFs, margin calls, and algorithmic selling can overwhelm logic short term. Investor psychology, not spreadsheets, dictates those first violent moves.